If you want to build real wealth, if you want to catch the big money moves before they happen, you can't rely on noise. You can't chase headlines. You can't outsource your thinking to someone on a screen. Real wealth in markets comes from understanding the machine beneath the surface. The cause and effect drivers, the cycles, the liquidity, the psychology, and learning to read the footprints those forces leave behind on the charts. This is not about predicting with certainty. It's about stacking probabilities. It's about preparation beating prediction. It's about putting yourself in the flow of capital, not guessing where the river might go. So let me ask you something. When you see a chart move, do you just note that it's up or down? Or do you ask, why? What imbalance is causing the move? Who is trapped? Who's in control? Where is the fuel? Because moves that matter, moves that build accounts, come from imbalances. Buyers overwhelming sellers, sellers overwhelming buyers. Liquidity drying up in one pocket, flooding another. Your job is to spot those imbalances while they're forming, not after they're obvious to everyone. And charts? Charts aren't magic. They're the visual ledger of human behavior. Every candle is fear and greed negotiating. Every range is indecision. Every breakout is a collective shift in conviction. Real money leaves footprints, heavy volume at inflection points, structures that compress like springs, momentum that leads or lags price at turning points. Learn to read those clues, and you stop chasing noise. You start catching signal. Let's map the terrain. Think in inputs and outputs. Inputs, interest rates, credit conditions, liquidity, corporate margins, supply-demand dynamics, positioning, regulation. Outputs, price, volume, volatility, breadth. If you track the inputs, the outputs stop surprising you. You're not predicting, you're updating your odds as new information hits the tape. This is the foundation. Now let's build the frame. Part 1. The market as a machine, cause and effect. Markets are auctions. Price is a negotiation. When liquidity is abundant, when credit is cheap, risk parity is hungry, buybacks are strong, and international capital is seeking returns. Risk assets levitate. Not because of a headline, but because funding is fuel. When liquidity tightens, when real rates rise, QT drains reserves, margins compress, and forward guidance chills, risk appetite bids thin, and gravity returns. If you anchor your view in these relationships, you gain patience. You know that short-term wiggles often live inside bigger flows. You know that why matters more than what, and that helps you act when others react, and wait when others chase. But macro alone isn't enough. Macro sets the tide. Price action sets the timing. That's why we combine top-down context with bottom-up execution. Big picture first. Precise entry second. Part 2. Time frame stacking. Map, path, step. Higher time frames reveal the map. Lower time frames refine the step. Start with the monthly and weekly. That's where the elephants move. That's where institutional flows leave tracks. A weekly base under multi-year resistance means something. A monthly reclaim of a long-term moving average means something. A weekly expansion in range and volume after compression means something. Once you see the map trend, key levels, broad structure drop to the daily. This is your path. Here you can see the mechanics of continuation or failure. Flags, channels, pullbacks into demand, failed rallies into supply, volume drying up on pullback, expanding on thrust. The daily tells you where the next battle might be fought. Finally, refine on the 4-hour, 1-hour, even 15-minute for entries. This is your step. Here, you look for triggers aligned with the bigger picture. A break and retest with rising volume, a shift in character, lower highs to higher highs, or vice versa. A momentum flip, a liquidity sweep and reclaim. By aligning step with path, and path with map. You stack probabilities. You're not guessing, you're synchronizing. Common mistake. Acting on a 15-minute breakout that's ramming into weekly resistance. It works until it doesn't. And when it fails hard. If you had started with the weekly, you'd know the wall is right above you. Reverse mistake. Panicking on a 5-minute pullback. That's nothing more than a daily higher low inside a weekly uptrend. The small view can scare you out of good trades if you don't ground it in a larger context. Part 3. Structure, volume, and momentum. The language of price. Structure is the grammar. Trends, ranges, bases, distributions. Higher highs, higher lows define uptrends. Lower highs, lower lows define downtrends. Ranges are balancing acts, supply and demand, negotiating equilibrium. Long ranges often precede long trends. The longer the base, the higher the space. Volume is conviction. Price without participation is a whisper. Price with volume is a statement. Breakouts with volume confirm real interest. Breakouts without volume are guilty until proven innocent. Watch volume on pullbacks. Does it contract? That's constructive. Does it expand? That's warning. Momentum is the tone. RSI, MACD, rate of change. They're not oracles, but they reveal acceleration and fatigue. Divergence is a tell. Higher highs in price, lower highs in momentum suggest the engine is losing torque. Pair divergence with major levels and you elevate your odds. Volatility is the weather. Compression precedes expansion. Narrow range days clustering. Expect a regime shift. ATR falling into a squeeze near a big level. Prepare for a breakout. Don't predict direction. Prepare for movement. Then let price confirm. Liquidity traps are footprints. Wicks through key levels that reverse quickly, often signal stop runs and position cleanses. A sweep of support that reclaims and closes strong on volume? That's fuel for upside. A push above resistance that instantly fails? That's a trap. Professionals sell the breakout to late chasers. Then price unwinds. Part 4. The psychology beneath every candle. Charts are maps of memory. Support and resistance exist because people remember pain and relief. Buyers trapped at highs become future sellers at break-even. Shorts trapped at lows become forced buyers on a rally. The more transactions at a level, the more memory embedded, the more likely it becomes a battlefield again. Fear and greed oscillate. Greed climbs the stairs. Persistent bids, shallow dips. Buy the dip confidence. Fear takes the elevator. Gaps, wide ranges, cascading stops. At extremes, watch for capitulation and euphoria. Panic with volume spikes and climactic candles can mark bottoms. Blow-off tops with vertical thrust and parabolic extensions can mark tops. The trick is to anchor these emotions to structure and liquidity, not vibes. False breakouts are behavioral Rorschachs. They lure with certainty. They reverse with violence. The better your read of context, the less likely you are to chase them. The pros probe liquidity. The crowd reacts. Your edge is to learn what their footprints look like and stand on the other side when the table turns. Part 5. From setup to execution, a repeatable process. Build a checklist. Turn art into process. Here's a practical framework. 1. Higher timeframe bias. Trend. Up, down, or range on weekly, monthly. Key levels. Are we approaching multi-year support? Resistance? Market regime. Liquidity expanding or contracting. Rates trending higher or lower. Credit spreads widening or tightening. Intermediate structure. Daily. Are there constructive patterns? Flags? Ascending bases? Volatility contraction? Is volume behavior supportive? Expanding on thrusts, contracting on pullbacks. Are we approaching a level with confluence prior pivot, moving average, volume node, fib cluster? 3. Trigger time frame. 4. Sitting is the one act that separates operators from noise chasers. The market will test you with shakeouts, pullbacks, overnight gaps, rumors, downgrades, misquotes, and every manner of nonsense. Your job is to sit if the wave is intact and cut if it's broken. What tells you it's intact? Higher highs and higher lows in an uptrend, shrinking reactions, support holding where it should, leading peers confirming, no distribution days stacking up in the broader indexes. What tells you it's broken? Lower highs, failed breakouts that don't recover, support that flips to resistance and stays that way, heavy selling into strength, the tape suddenly rewarding bad behavior from the stock. You don't sit out of stubbornness. You sit out of alignment with the trend. The day that alignment breaks, you stop sitting and start exiting. But what about getting the bottom? What about selling the top? That's for storytellers and drunks to brag over. The money's in the middle. Take the fat part of the steak. Let someone else fight over the sizzle. You'll live longer. I never built a fortune by buying at the exact bottom. I built it by buying when the market already agreed with me and selling when the market started to disagree, and not a moment later. The rest is vanity. You know, I can tell how someone will fare in this business by how they behave when nothing is happening. The professionals conserve energy. They do their homework. They build watch lists. They note which stocks refuse to go down when the market is soft, and which ones refuse to go up when the market is strong. They pay attention to the quality of reactions. They notice if a stock offers second chances to buy weakness or if it makes you chase. They get interested in the former and suspicious of the latter. They write things down, levels, characters, quirks, so they're ready when the tape rings the bell. The amateurs, in the same stretch, flip coins for small stakes and call it practice. The only thing they practice is how to lose small amounts frequently until the habit becomes a reflex. When the real move comes, they're too fatigued or too broke to step in size. Here's something else. You don't need to trade all the time. You need to be right at the right times. 10 trades a year can make you rich, if they're the right 10 and you size them honestly. 100 a week can make you broke if they're driven by boredom. A good operator knows the difference between absence of opportunity and absence of activity. One is the market's condition. The other is your condition. If you mistake your need to feel busy for the market offering a trade, you will slowly burn your capital. No system can save you from that. Let's talk about risk, because nothing ends a career faster than forgetting it. Risk is not how far a stock might go. It's how far you will let it go against you. Risk is always your decision. People talk about volatility as if it's weather. It isn't weather. It's waves. You don't control the waves, but you control whether you're standing knee-deep when they crash. If you can't define your exit when you enter, you're not trading, you're hoping. Hope is a wonderful emotion in church, a ruinous one in the market. Draw the line where the premise is wrong. Trade smaller if the line is far. Trade larger if it's close, and the odds are good. Never let a position grow larger because it's moving against you. That's how men vanish. You might be wondering about news. What about macro? What about the Fed? What about earnings? Fine, listen. But remember, the tape will tell you the impact. It always has the last word. If the Fed speaks and the market rallies for an hour and then sells all day on rising volume, the message isn't in the speech. It's in the selling. If earnings beat and a leader plunges, don't defend your model. Defend your capital. The tape is the final judge. The more you outsource judgment to pundits, the later you'll be to the real move. The street is littered with men who were right about the narrative and wrong about the price. The price is where you settle your bets. Ego ruins more traders than bad luck. Ego wants to be right, to be praised, to be clever. It will have you averaging down because you know you're right. It will have you holding a loser because you know the market is wrong. It will have you selling a winner because you're afraid to look greedy in front of your own mirror. Failed breakouts. Powerful reversal setups. A breakout that closes back inside the range on volume is a tell. Target the other side of the range, or the origin of the move. Divergences. Pair them with levels. Momentum weakening into major resistance is a warning light. Strengthening off major support is an early green shoot. Part 9. Execution tactics. From theory to trade. Liquidity sweeps. Let the market run stops at a level, then wait for the reclaim and a higher low to form. Enter on the reclaim, or the first pullback. Stop below the sweep low. This aligns with how algorithms clear liquidity. Initial balance and opening drive. For intraday, first hour sets tone. Breaks and holds of initial range with volume can frame bias. Always map to higher time frame levels. Range to trend transitions. Identify evidence of character change range. Highs no longer sold aggressively. Dips get defended faster. Volume expands on up legs. When character changes, your playbook shifts. Trailing stops by structure. Rather than a fixed ATR trail, consider trailing below swing lows in uptrends or above swing highs in downtrends. This respects market structure and keeps you in the move. Scaling method. Start with a core aligned with higher time frame. Add on confirmation. Retest. Hold. New higher low, keeping total risk bounded. Don't add if your stop is worsening the average risk profile. Part 10. Mindset, where edge is kept or lost. Your edge isn't just your setup, it's your behavior under pressure. Patience versus boredom. Boredom is not a signal. If there's no high-quality setup, doing nothing is a skill. Cash is a position. Discipline isn't punishment, it's freedom. Rules liberate you from impulse. Your plan is a shield against your own wiring, loss aversion, FOMO, sunk cost fallacy. Detach identity from outcomes. A loss is data, not a verdict on your worth. Review process, not P.L. alone. Expect variance. You can do everything right and still lose. You can break rules and win. Don't let short-term outcomes rewrite long-term rules. Compounding requires survival. Big wins matter, but avoiding big losses matters more. Be around for the fat pitches. Part 11. A practical weekly workflow. Weekend top-down. Macro scan. Yields, dollar, spreads, major central bank cues. Index review. Monthly, weekly trends, key levels, breadth measures. Sector rotation. Relative strength. Leaders versus laggards. Watch list. 10-20 names with clean higher time frame structures. Daily routine. Pre-market. Update levels, catalysts, gaps. Define A+, B, and pass setups. Intraday. Focus on your plan. Avoid distraction. Execute triggers. Post-market. Journal trades, screenshots, notes on emotions and adherence. Monthly review. Metrics. Win rate, average R, expectancy, max drawdown, adherence score. Playbook. Which setups worked, which didn't. Adjust filters, not principles. Part 12. Case study narratives. Conceptual. The base that built a trend. Weekly. 18-week base under multi-year resistance. Volume gradually increasing. Market breadth improving. Daily. Higher lows compressing into resistance. Pullbacks shallow. Volume contracting on dips. 1 hour. Breakout. With volume surge. Quick retest. Strong reclaim. Execution. Enter on reclaim. Stop under retest low. Scale at first measured move. Trail under higher lows. Ride until weekly. Momentum diverges into next resistance with distribution volume. The trap at the top piece. Weekly. Extended advance into historic resistance. Momentum divergence across weeks. Rising volume, but heavy wicks. Daily. Breakout above resistance, but immediate failure. Close back inside range on high volume. 1 hour. Lower high after the failed breakout. Breakdown through range midline. Execution. Short on breakdown after failed breakout. Stop above failure wick. Cover at range lows. Hold runner for potential trend change. Manage risk aggressively. The capitulation and reclaim. Weekly. Protracted downtrend into prior cycle support. Sentiment. Extreme pessimism. Daily. Panic. Spike down on volume. Massive lower tail candle. Next day inside bar. And then upside break. 4 hour. Sweep of lows. Higher low forms. Reclaim of key level. Execution. Long on reclaim. Stop under. Sweep low. Trim into first resistance. Trail remainder. Add on first bull flag. Part 13. The art of holding winners. The big money isn't in the entry. It's in the holding. That's where discipline becomes hardest. Pre-plan exits. Partial at 1R, 2R into obvious resistance. Trail the rest with structure. Decide before you're in the trade. Let market pay for risk. Take a small partial to remove original risk, then widen your stop behind structure to capture the swing. Don't let a small winner become a loser. If the character changes and your conditions break, honor the stop. There will always be another trade. Part 14. Common pitfalls and antidotes. Overtrading. Too many B setups dilute focus. Antidote. Minimum criteria checklist. Trade fewer names with more depth. Averaging losers. Turning trades into investments. Antidote. One thesis, one stop. Re-enter only on fresh signals. Indicator overload. Analysis paralysis. Antidote. Price, volume. Structure first. 1 or 2 momentum tools as secondary. Ignoring correlation. Hidden concentration risk. Antidote. Map your exposures by factor and macro driver. News chasing. Late to the party. Antidote. Let price confirm the impact. Trade the reaction, not the headline. Part 15. The wealth builder's mindset. Wealth is built quietly, in silence, not in the noise of constant action, but in the discipline of selective aggression and persistent defense. You don't need 50 trades a week. You need a handful of asymmetric opportunities each quarter, managed with care, held with patience. Treat every dollar as a soldier. Don't send them into battles with poor odds. Deploy them where terrain, weather, and timing align, where higher time frame trend, intermediate structure, and lower time frame trigger converge. That's your edge. That's your fortress. And remember, success is not linear. It's stair steps, long stretches of preparation, then sudden leaps when the conditions line up. Your job is to be ready when the door opens, not to bang on it when it's locked. Closing. A final reminder. Markets are human behavior expressed in numbers. Fear and greed leave footprints. Liquidity seeks return and creates tides. Your craft is to read the footprints, feel the tide, and act with rules that protect you from yourself. So ask yourself, am I starting with the map before I study the ripples? Am I trading with the tide or fighting it because I want action? Do I have a checklist that removes guesswork and anchors me to process? Am I risking small enough to survive being wrong and big enough to benefit when I'm right? Am I patient enough to wait for the real ones? If you honor those questions, the market won't reward you every day, but over time, it will reward your discipline. Preparation creates opportunity. Process creates consistency. Consistency creates compounding, and compounding builds wealth. Now, zoom out. Mark your levels. Note your regimes. Build your watch list. Then, wait. When the footprints show up, volume expands, structure resolves, momentum aligns, move with conviction. That's the game. That's how you catch big money moves early. Not by guessing, by reading the map, walking the path, and taking the step again and again, with clarity and control.